Welcome to Value Add, your edge in building wealth.
You've probably heard of someone either in your friend circle, your family, or even someone online that's built their wealth by investing in real estate. But you probably haven't heard much about investing in real estate private equity deals. Well, that's because we as individual investors are typically priced out of those deals. The minimum investment requirements are very high, and the deal sizes can go in the hundreds of millions of dollars. So they're typically only open to institutional investors, ultra-high net worth individuals, or family offices. In this episode, I sit down with Alan Donenfeld, the CEO of CityVest, to learn about investing in real estate private equity deals and how his platform at CityVest provides access to those deals to accredited investors. Hey Alan, thanks a lot for joining today.
Great to be here.
Today we're here to learn about investing in private equity real estate deals. But before we jump into that, we'd love to hear a little bit about your background, how you got into starting CityVest.
Be happy to. I've been in financial services and investing for a little over 40 years, $3 billion of transactions. Started out in the 80s for 10 years working in large investment banking firms doing merger and acquisitions, private equity deals. Formed a broker-dealer that I ran for about 25 years. Ran a hedge fund for 12 years, did quite well. And then with my own capital, started looking at what I should be investing for myself. After about 6 months of research, realized that all of the ultra high net worth investors are focused to a large extent investing in real estate. So groups like Tiger 21, which is an investment club where members must have at least $10 million in net worth. Their highest allocation to an asset group is to real estate at about 22, 23%. So when I started to look to invest my own capital, I realized that the real estate private equity funds like KKR, Blackstone, Colony have $10, $20 million investment minimums. But even the smaller real estate investment funds have minimums of $250,000, $500,000. For my own capital, which was around $100,000 per investment, I couldn't gain access to those private equity funds. So I created CityVest to provide unique access to what I think is the best asset class, real estate private equity funds.
Real estate is the largest asset class, right? When you mention that all family offices, all high net worth individuals are all investing in real estate, it makes a lot of sense. When you were in your banking years, were you focusing on real estate at that time as well? Or was that something that you dove into more after the fact?
Yeah, so in the 80s in investment banking firms, I was doing merger and acquisitions, very large, multi-billion-dollar companies, fairness opinions, takeovers of companies. It was not real estate related. Yep. And then in the broker-dealer, it was predominantly public securities work and some leveraged buyouts, private equity. Even in my hedge fund, it was mostly small cap stock. So I've come to realize how great real estate is in the last 10 years, which has been a great time in real estate. Obviously, the attributes of real estate versus other asset classes is real estate's a hard asset, provides a cash yield, easy to gain leverage, which increases rates of return, has tax advantages from depreciation, and provides for a fairly significant equity buildup. None of those attributes are all present for stocks or bonds, cash, crypto, or other commodities. The empirical evidence is that commercial real estate over the past 20 years has had a little over a 10% annual and IRR calculation return, which is higher than large cap stocks, small cap stocks, commodities. Yep. It's the highest rate of return. But in combination, it also has a fairly low standard deviation or risk factor. So the combination of a high return and low volatility makes it that best asset class.
It sounds like it. So investing in real estate, definitely something people should look into. CityVest specifically focuses on real estate private equity. So could you tell us a little bit about what the difference is and why investing in real estate private equity is beneficial.
So once you realize that real estate is the best asset class, the question is, how do you access real estate investments? The most accessible form of real estate would be to invest in a REIT. Public stocks, highly liquid. You can buy it and sell it whenever you want. REITs are attractive, except the rates of return from public REITs aren't very good. Typically, the distributions are down about 3.5%. They typically do not have value add strategies. They don't buy distress. They don't buy development properties. They're typically buying core properties, cash yielding, and you're just not maximizing the rate of return from real estate. There's also deal syndications. Typically, they have fairly high fees. If you don't know the managers, there's some risk with those sponsors. And so those returns are generally underperforming other areas. Real estate crowdfunders have a little bit of negative selection in that if a sponsor can't get his deal funded through a private equity fund or friends and family, then they may go to a crowdfunding platform as a last resort. Those are the deals that you just don't want to do because they're not the best deals in the market. That leaves you with real estate private equity, which are typically investment managers that have achieved a level of experience both in years and dollars of deals done, dollars of deals realized. To the extent that they have a great track record, then the institutional money will flow to them. So the larger the private equity fund, generally the more trustworthy, the safer that fund will be. Funds typically have an audit and an administrator. So when you combine that corporate governance with a level of experience, a large investment management team that may include the acquiring team, the value add or the improvement group that's going to improve the properties, the accounting, capital markets, when you combine all of that, it ends up to be not just a team that can produce outsized returns, but it's also quite a bit safer.
That's very interesting. I want to double click on that point that you brought up about crowdfunding platforms. There are a few of them that are coming out these days. Your point was that the deals that the real estate crowdfunding firms are getting are typically deals that aren't being funded elsewhere. Could you elaborate maybe a little bit more on that? What the fundraising process typically would be and how they end up on crowdfunding platforms? Then I think you already touched on, from a real estate private equity fund perspective, there's a lot of due diligence. There's a lot of auditing and ensuring that these deals are at quality. That's why I would imagine the preference for these commercial real estate deals is also to get funding from private equity funds as opposed to crowdfunding platforms.
Sure. So the reason to invest in real estate is because of leverage, the hard asset, equity buildup, tax advantages from depreciation. All of that combines to produce the ability to achieve somewhere between a 15 and 20% level of return. That's a great return. If you can do that year after year after year without having any hiccups, that makes the best asset class. What ends up happening in a crowdfunded deal is it's a single deal, so it's not diversified. First, that adds a significant level of risk. Also, if it's a single deal on a crowdfunding platform, it might tend to be a smaller transaction. And smaller transactions are, just by their nature, a lot more competitive bidding when there's a small asset. So if it's a $10 million asset, which requires $3 or $4 million of equity, there's, thousands of people that can compete for that property. But if you're talking about a $100 million property and it requires $30 million of equity, the number of sources for $30 million of equity is a lot smaller, less competitive bidding. If you have private equity firms bidding, they're not going to go crazy and say, we're willing to accept a 4% return. They have investors that they have to report to. So they want to fine tune their offer to buy a property so that all of the bidders usually end up in a small band where the targeted rate of return is around that 15 to 20% level. Also in a fund setting, because it's bigger, you can afford corporate governance like auditors and administrators. I would caution anybody when they're investing, make sure that real estate investments that you make also have that same sort of corporate governance, audits and administrators. Bigger is better in real estate, and funds offer a diversification of capital, of geographic region. If you have 10 properties in a real estate private equity fund, you'll get that geographic distribution. There's also a way of calculating returns with a preferred rate of return and a hurdle for the investment fund manager. So in a fund setting, there's a fair calculation of the netting of the profits so that in a fund, the manager doesn't get a undue amount of the profits as they might in a single property.
I think that's a great segue. Can you tell us a little bit about CityVest? You guys started in 2014. You saw this gap in the market where private equity deals were available, but the capital amount was probably high for the average investor.
Sure. So it took us a number of years of investing in real estate private equity funds in order to fine-tune how best to access that market. Initially, they were just simply feeder funds that myself, my brother, and some other investors were combining capital in order to meet the high level of minimum investment size that most private equity funds have. So for a couple of them that were at about 250 to 500,000, we had a group of investors coming together to meet that minimum. We did this a couple of times, and as the group came together and the amount went up to several $1 million, I was then in a position to negotiate with the underlying real estate private equity fund into which our feeder fund would invest, specifically a 12% preferred return and then an 80-20 split of profits. But we're able to do that because we've combined or aggregated capital into our feeder fund. CityVest calls it a access fund. That's as opposed to if you were investing in a private equity fund directly, one, you would need 250,000 or 500,000 as a minimum, but they would only offer you an 8 pref, maybe even a 7 pref, and then an 80-20 split. In some funds, it's a 75-25 split or a 70-30 split. That gets to be a little unfair for the investor.
So is your leverage the amount of capital that you're able to raise through CityVest, or how is CityVest able to get these good terms?
The great terms. So we review about 700 funds a year and whittle that list down through vetting and reviewing documents down to about a dozen different funds. And typically they're offering 7-8% preferred return, and then that split 80-20, 70-30, 60-40, whatever it might be. We then negotiate with that underlying fund because we will be investing from a feeder fund that CityVest is set up. We will aggregate $1 million amounts into our feeder fund. And so that underlying fund that we've selected as meeting a variety of due diligence requirements, they really want to get our $1 million investment amount. So because of that, they agree to that 12% pref and then 80-20 split of profits.
What's the minimum investment amount on CityVest right now?
We allow investors to come into our feeder fund or access fund at a $25,000 minimum, but all investors must be accredited investors. The average ends up to be about $60,000.
Could you walk us through how the platform works? So, for example, you have a deal, you work out the terms, it's on a platform up for getting funded, and it's open to investors to invest. So what does an investor see? How do they kind of get into the deal?
Yeah, sure. So the history of that transaction might be reviewing those 700 private placement fund documents, interviewing managers, doing due diligence on their realized track record. We require all funds to have generated at least a 20% IRR on prior realized deals that they've done. So there's a substantial vetting upfront. For example, if they're buying properties in Minnesota, it might not be a growth market that we like, as opposed to Texas and Florida, where we know there's a population increase. We then negotiate a side letter agreement, which documents our enhanced investment term. Once we've concluded that, we then post their information at cityvest.com. You can find our deals at our investments page and then dig in. You don't have to register. It's free to gain access to looking at our transactions. You can review their overview, key considerations, strategy, the investment team of the underlying fund, the investment terms, track record, and documents. Then CityVest conducts group conference calls as well as a video interview with the underlying investment manager, where we review all aspects of the fund, historical track record, strategy, why they've selected their team, the terms of the investment, and all the details that are in the underlying fund manager's investment deck.
Got it. So what's the typical lockup period for an investor?
Real estate is inherently a long-term asset. It's not something that you're in for 3 months or even for 2 years. The typical fund, the way that they will make money is, and this is not true in every case, and real estate varies widely from industrial properties, medical office, distressed senior living, multifamily, hospitality, retail. So it varies significantly. Our focus has been on multifamily in growing markets, predominantly in the South, but it could be in California, Seattle, Las Vegas has been a good market, Phoenix, Texas. So it could be in many different geographic areas and different strategies. Every fund varies. Some are stated as 4 years or 5 years. Some are 7 years. Oftentimes there's extensions of 1 or 2 years, but typically any of these funds will be buying 5 to 20 different assets, and they will start selling assets in the 3rd and 4th year. By the time you get to the 5th or 6th year, they may have sold 50, 60% of the portfolio, and you've gotten a return of that capital. But there may be 1, 2, 3 assets that they still haven't sold by the time they get to the 6th, 7th, or 8th year. But by that time, you've gotten at least all of your investment back, plus a strong return. Any real estate fund that does go to the 7th year, I would expect us to get at least a 2 times equity multiple.
So we talked a little bit about your due diligence process and the track record that you look at for the private equity funds that you're considering investing in. What has CityVest's track record been so far?
Right. So we've done 15 different feeder funds. Again, we call them access funds. It's a little over 50 million in assets under management. Only one of them has gone fully round trip and returned all of the capital plus gains and distributions. But most of the funds that we've invested in have returned anywhere from 10% to about 75% of the original capital. So investors have gotten back a bulk of the money that they've invested in, but these 15 have not gone round trip where all of the assets have been sold. But because of the vintages, the year that we made the investment in 2019, 2020, 2021, all of those were excellent vintage years where prices were very attractive, locking in low rate debt financing. And from that point, when we made the investment, 2019, 2020, 2021, rents have gone up fairly significantly, even though right now in end of the first quarter, 2023, rents are coming down a little bit, as much as even 10%. But that 10% drop in rent is far less of a drop than we saw just last year, where rents went up in many places 20 and 25%. Therefore, all of our funds are going to produce 20% plus kind of returns. We'll have to wait and see by year 5, 6, 7 where that ends up, but I fully expect them to be over 20% IRR on the funds we've invested in.
I'm excited to see the results of that when they do come out. I think you mentioned when we were talking a little bit about having a third party better as part of your due diligence process. Could you talk a little bit more about that?
Sure. On all of our transactions, it's about safety and returns. If you follow Warren Buffett at all, his number one rule is never lose money in any given year. That goes to safety. His number two rule is never forget rule number one. So we put that as paramount on our list also. We never want to lose money in any given year on any investment. One way to do that is obviously first that corporate governance, having the auditor and administrator, but on every transaction, we commission a third-party due diligence firm to write a report on every underlying fund manager. They review years and dollars of experience. They actually read the corporate governance documents from the auditor and administrator. They go through background checks at the SEC, FINRA. They do specialized checks to see if there's any liens or bankruptcies, litigation, drunk driving arrests. They confirm that there's a key man life insurance policy on the key person at that management company. So all of this is in a report. It's posted on our website for everybody to read and makes the deal just that much safer, given that a third party has also reviewed that investment manager.
It sounds like you're taking a lot of time to make sure your investors' money is safe. And my next question to you is, I'd like to learn a little bit more about the fees that CityVest charges, and then what is CityVest's business model in terms of making money?
So the value proposition for an investor is that CityVest goes out, spends its time vetting real estate funds, finding what we think are the best fund managers, negotiating better terms, structuring our access fund to allow $25,000, $50,000 investors to gain access through our access fund, our feeder fund, to invest in that fund that we think is a great fund manager. We charge 1.75% per year. That is an annual fee that CityVest earns. The value for the investor is that we've gotten a 12% pref. So theoretically, 12 pref minus 1.75 in annual fees brings you down to a 10 and a quarter theoretical net pref. And that's higher than the 8 pref. So it's a solid value.
You mentioned rental prices are reducing, but the market did increase significantly over the last 2 years. My question to you is, last year we saw a huge spike in inflation. Inflation is still increasing, but at a lower rate currently. Curious to know your future outlook for commercial real estate and the industry in general.
It's a great question, and it's a very difficult question. The number of real estate acquisitions that are occurring right now over the last 3-6 months is significantly diminished from where it was at a year or two ago. The reason is that just this week, 30-year mortgage rates topped 7%. They had gone up, they fell back to about 6%, and now they're back up to 7%. And we are facing more Fed rate increases in the next 2, 3, and even 6 months. So I don't see interest rates coming down. With very high interest rates at the approximate same level as cap rates, the rate of return that you would get from an unlevered piece of real estate, it's very difficult to make any sort of cash on cash return from real estate. So it's not a great environment to make real estate investments. But what is beginning to happen because of these very high interest rates is some of those syndicators, maybe even crowdfunded deals, who may have bought properties using bridge debt or floating rate debt because it was readily available at 2.5 to 3.5%. They might be caught today where that floating rate or bridge debt is now at 6% or higher. The property is now not operationally distressed, but financially distressed. The cash flows coming from the property are not covering the debt service that those syndicators or crowdfunders, maybe even some funds, incurred in buying the property. We're talking about hundreds of billions of dollars of debt that was financed with CMBS, floating rate debt, bridge debt, where the properties are now underwater. And this has been a growing problem for the last 6 months. Maybe people have been held on till now, but banks and other private lenders are getting ready to foreclose on the financially distressed real estate deals. In order for prices to come down in real estate, in order to make acquisitions more appealing, there will be a build-up of distressed real estate assets that are going to come to market. With that volume of deals in the market, there'll be lower prices available throughout the industry on real estate assets. That will become a huge buying opportunity for anybody investing in a real estate fund, sitting with cash in the bank, ready to pounce on those deals that they find. Remember, these real estate private equity might have 10-man acquisition teams in 5 different cities speaking to every real estate broker, and the brokers want to speak to them. Because again, these are funds with cash in the bank. These are the best buyers in the market. They can close on properties. A sponsor who doesn't have money needs to crowdfund the equity. They can't move quickly in buying a property. They need to raise the money on a crowdfunded platform. But a fund manager has the money in the bank. They can move quickly on a distressed property. Any fund today is looking for those kind of opportunities where somebody is forced to sell a property, and you want to be invested in those funds today to take advantage of the opportunities that will be presented to them over the next 6 months, year and a half. There will be some great bargains that will be obtainable. You don't necessarily have to obtain the best debt financing today. You need to buy the property right. Maybe you don't want any debt financing because of the cost today. And then you can refinance in 2024, 2025 as rates start to come down. That's what we've seen in every real estate and rate cycle is rates go up to reduce inflation. Then as inflation starts coming down, maybe that's in 2024, late 2024, we'll start to see rates come back down. Then all of these funds will refinance, maybe even recapitalize those properties when they've obtained great acquisition prices in the distress that we are likely to see for the remainder of this year.
That makes a lot of sense. So if you're cash rich, then better buckle up. It sounds like there's a huge potential buying opportunity coming up. But if you've been financed by debt, especially variable rate debt, it sounds like you might be in a little bit of trouble right now.
So single assets, the sponsor has incentive because the pref followed by a percentage of profits gives the manager incentive to try to hit a grand slam on each and every transaction because the gains don't get offset against any other investment gains. For a sponsor doing individual deals, he might not make anything on one, but he'll make 20% of the profits on the other without netting the losses. But in a fund setting, you're going to net all of those transactions. So it's a fairer calculation for the investors to be in a fund. So when funds go out now looking for the distress, it is hard to find those transactions today, but they are beginning to present themselves. And I believe now that we've had interest rates go back up over 7%, that's again for 30-year mortgages, none of these commercial deals are being financed with 30-year paper. So that 7% rate is not what institutional funds would borrow at. They would borrow at something closer to 5% in today's market on a shorter term basis. So I think that the advantage to invest in a real estate fund today is you're giving money to an opportunistic investment fund manager who has the capability to deploy capital in the bank for fantastic deals that are available today and refinance or recapitalize them over the next 2 years, targeting high teens, maybe even a 20% net IRR for the fund, which is a fantastic return from real estate.
That makes a lot of sense. Given that, what is CityVest's plan over the next year to few years as we see interest rates continuing to increase and then potentially once inflation turns over or gets to a point where the Fed is more comfortable around the 2% that they've been saying, although I'm not really sure about when that's going to hit?
So we plan on doing around 5 access funds a year. We are not like a lot of firms that are focused on keeping 5 investment opportunities on the site at any one time and let buyer beware, let them choose. We love every deal that we do. We do a lot of due diligence. It takes us a significant time to vet them, structure them, work on the documents. And so we're very judicious in the pacing. So we're not going to do 20 deals the next year. 5 is about our structure. We are working on a liquidity fund so that any investors that do invest in our access funds will, in the future, if this comes about as we expect, will be able to exit early. So even though we did talk about real estate private equity funds being illiquid for 4, 5, 6, 7 years, we are working on the ability to buy in our investors, providing them liquidity if you need to buy a house or college education for kids, or whatever the use might be, any sort of distress, your business has an issue. We're working on that liquidity fund so that you can gain access to your capital if you do need it.
How would that work? Would you essentially sell that to another investor in a secondary market?
It actually is called a secondary fund, and it would be us buying in our own investors because we know our access funds better than anyone else. And we like our own deals, given the 12% pref that we've been able to negotiate. We'd rather buy our own 12% deal than the direct investment with an 8% pref. So I don't really want to buy anybody in the underlying fund. I want to buy our own access fund investors who have that 12% pref. So our target would be the 50 million that our own investors have already invested. And then going forward, as we do another, say, 5 investments this year, if you need to get out in 2 years, 3 years, 4 years, we would have a fund to provide that liquidity to you.
That's very interesting. So I guess this leads me to that question, right? Does CityVest have any skin in the game? So are you guys investing your own capital as well? Or is the platform only to connect investors to private equity real estate funds?
Yeah, so we used to invest years ago in these transactions. We don't any longer because we've just done too many of them and it would tie up too much capital. Although CityVest will be investing in this liquidity fund, the secondaries fund. So we will have skin in the game in that fund. And that fund will also make the investments into the access funds tree.
That makes a lot of sense. This has been a lot of great information. Before we jump off, I would love to ask you some questions on your personal investing experience. What are some tips you would give to people who are just starting out to invest, whether it's public market, looking at private placements, some lessons that you've learned over your career that you'd be able to share with us?
So a couple of important themes. Obviously, I mentioned Warren Buffett, never lose money. You know, a lot of people have invested in crypto. For my own money, for long-term money, yes, if you want to put 2% of your net worth in crypto, 5% in crypto, that's fine. But the overarching rule is don't lose money and be diversified. So don't go all in crypto. Keep it to a small number. If you make 20 times your money, terrific. I would say a better investment than crypto would likely be something like venture capital. And I would not recommend that anybody utilize platforms for picking your own venture capital transactions. Obviously, the same reason that I wouldn't recommend picking an individual real estate deal on a platform, I would say invest in a institutional venture capital fund, which has a diversified portfolio, and let those guys worry with the details of whether it's better to be in machine learning and AI and deep tech and all of the specifics of what venture capital firm might be focused on. Let the professionals manage your money. That's the way to reduce your risk. Venture capital has done well. Private equity has also done well. The general model that any financial advisor would talk about would be a split between stock, bonds, and alternatives. It used to be just stocks and bonds, 60-40. I think everybody realizes that not only does your risk get reduced by adding alternatives, but your rate of return goes up. So if you follow the model of Yale's endowment or Tiger 21, you should have at least 20 to 25% of your portfolio in real estate. I think that's the right number. The average allocation that individuals have today is about 3%. So individuals are grossly underweighted in real estate, and I think that'll be changing over the next 10 years. It may well turn out that a model portfolio in 10 years is something like 40% in stocks, 20 to 30% real estate and other alternatives, maybe something like 20 to 30% in other assets, might be a variety of private equity funds, venture capital, wine funds, art funds. There's a variety of other alternatives that you can invest in.
That's a lot of great advice. You mentioned that right now the average real estate position is about 3% of the portfolio. A lot of people feel like they're priced out. I'm not talking about necessarily private equity firms, but given the significant spike in prices that we've seen over the past 2 years, retail investors even looking to buy homes. Curious to know your position on, one, you're at the intersection of finance and technology, and you're trying to reduce those barriers to entry, but there's also the barrier to entry of accreditation. The entire reason that accreditation base is in place is to protect investors, because these are private placements, private companies. They don't have to provide financials, so there's a higher risk of fraud. But at the same time, there are enough funds or enough places to put your money, which might be relatively safer than, for example, the stock market, or even you mentioned crypto. What are your thoughts on that aspect of the coin, where there isn't enough access to some of the safer investments for the average Joe?
So the SEC's mantra has always been that they're looking to protect individual investors, and they think they're protecting individual investors by making it harder for those investors to access alternatives. I think it really should be the opposite. Why do institutions predominantly invest in alternatives? Because they're a better asset class. They produce higher rates of return. And yet a non-accredited investor is precluded from accessing those very investments. So I don't think the SEC is doing the public justification by excluding them. The accredited investor standards are that you have to have a salary in the past 2 years as a single person of $200,000 or more, or $300,000 if you're married, or a net worth test of over $1 million net worth, excluding your home. I think there are other ways to gain accredited status. These days, there have been a couple of ways to do that by being a member of a broker-dealer. I think in the coming years, there will be additional methods to test into being an accredited investor. But for now, our investments are only available to accredited investors.
Well, Alan, thanks a lot. I think listeners and watchers have a lot to take in. This was super helpful. Thanks for coming on the show.
It's been my pleasure. If you want to reach me, the website is www.cityvest.com. My email is Alan, ALAN, @cityvest.com. If you want to reach me, call 917-747-3091. There's a lot of educational material at our website to learn more about real estate investing, private equity funds. Hopefully you've learned something here, and happy to see you on our website.
Thanks, Alan. Appreciate your time.
Excellent. Have a great day.
And that's today's value add. If you like today's video, hit the like and subscribe button below. For long-form written content, subscribe to my Substack. Otherwise, follow me on Twitter. See you there.